Hey guys, thanks for dropping in. I'm Ty. This is Stock Muscle, and today I wanted to talk to you about a stock that I personally own at $17 per share. I actually added to my position at about $19 per share. Legitimately, I think this company could be at $40 per share in no time. It'll be hitting the NASDAQ tomorrow, June 1st. Let's chat about it. All right, so the company that I was referencing in the intro of the video was a company that you may or may not know. Company name is Sofi. They are a fintech company that allows you to do pretty much all of your banking in one place. I am personally a Sofi member, so I have a bit of a bias to the company because I've been using them for about a year now. But I've been very happy with the company. They allow you to pretty much do all of your banking. They have a credit card that I use. They also have the financial services aspect, so I hold my stocks there as well. They do a very good job at creating a vertical banking environment. Like it a lot. And, the great Peter Lynch used to say, buy what you know. If you read his books, he told stories about going to the mall at the time when the mall was more popular, with his family, and they would lead him to companies that he didn't know about, which would subsequently lead him to some of his best investments. So I believe in buying what you know, and SoFi is a good example of putting that idea into action. So I'm a SoFi shareholder. The company's going public via a SPAC. So I don't know if you guys have heard about SPACs over the last year or two, but they've been all the rage. They brought or are bringing several companies public. SoFi, in my opinion, is one of the best ones. So I want to talk about why I went from just being a member of the company to an actual investor in the company. So we'll get into that. But once again, the company's going to trade publicly starting on June the 1st under the ticker symbol of SOFI. The old ticker symbol, if you check it out tonight, is going to be IPOE. That one's going to be done away with. So once again, the new ticker is going to be SOFI. So enough about that. Let's get into why I decided to become not just a member of the company, but an investor. So, with SoFi being a fast growth company, if you will, which is the best way to categorize them at this point, they're looking for fast growth. One of the first things I like to look at is the membership numbers. If you're keen to the market, you've heard the term monthly active users. You want to look at the members to make sure that the company is able to consistently grow their membership numbers. At this point in their growth story, there can be no stagnation in memberships. You want to see that number consistently going up. That means the company is doing a great job at attracting new clients. So you constantly want to see that number going on an upward trajectory. I think SoFi pretty much hits the mark here. So if we look at the membership numbers, and let's do year over year here, we're not going to do quarter over quarter. So if we jet over to quarter one of 2020, SoFi had about 1 million users. Strong number. If we jump ahead to Q1 of 2021, SoFi has been able to grow their user base by over 100%. They're sitting at 2.2 million users now. So we're talking about 110% growth in year over year users. That's strong. Now, of course, we know that that's not going to continue perpetually, but right now in the growth story, this is what you want to see. You want to see strong user acquisition and retention. You want to see those membership numbers continually climb up. SoFi is doing an excellent job there. That's the first thing I looked at, when I considered making the investment. Second thing you want to look at for a fast-growing company is fast-growing revenue. You want to see the revenue jumping a lot. So let's take a look at what SoFi has been able to do with their net adjusted revenue. So if we look at the chart, and once again, let's do year over year. Q1 of 2020, the company was able to bring in $86 million. If you compare that to Q1 of 2021 in the Carolina Blue there, they were able to bring in $216 million. That is 151% year over year growth. That's what you want to see from a fast growth company. Now, once again, none of this is perpetually sustainable. All companies get to a point where they're fully mature and they admit that revenue is not going to be going up as much. And that's when you typically see companies start to issue a nice dividend. They're going to pay you to hold on to the stock because they know that the growth story is starting to slow at this point. And most investors want growth. So you'll see that happen. But back to SoFi, very strong year over year growth. Very impressive number. The next thing and the last thing we want to look at, and in this video, I just want to go over the three key things. The last thing I want to go over is EBITDA. EBITDA, if you don't know what it means, let me go over it, is earnings before interest, taxes, depreciation, and amortization. Being an ex-broker myself, you would hear the term EBITDA, or in its place, you would hear raw earnings. So EBITDA, if you think about it, is a raw look at the earnings numbers. So let's look at what the company's done with EBITDA. Once again, we're going to go year over year, not quarter over quarter. Q1 of 2020, the company was negative. They reported $66 million in the red. They're negative. Q1 of 2021, however, they've gone EBITDA positive. So they're reporting $4 million in EBITDA earnings, which is plus 70% year over year. The company's heading towards profitability. So with fast growth companies, eventually, ultimately, the company wants to get to profitability. They want high revenue, they want high net income, and it really depends on the industry. Some industries are going to have higher net income than others. For example, if you look at sports and outdoors, which I'm really big on now, they've pretty much got very low margins. 5% is the expectation there. Some have hit as high as 10%, but generally speaking, it's going to be a low net income or a low EBITDA number. But with fintech and tech companies, the expectation is high. These companies don't have as much overhead. There's less stopping them from turning revenue into income, if you get me. So the expectation for SoFi is that EBITDA and net income is going to be high at some point in the future, but I think the company's on the right track. So looking at SoFi, those are three strong indicators that you like to see, and let's recap them. So first, we want to see from our fast growth tech companies, we want to see strong adaptation. We want to see strong user growth. We also want to see that revenue is growing fast. We also want to see that net income or EBITDA is actually growing. Now, once again, with EBITDA, it's not always with fast growth companies, net income and EBITDA it can be negative, and we can accept that. But ultimately, the goal is to get to profitability. That's why we're playing this game. It's not for you to be net income negative for the duration or the lifetime of the company as a publicly traded entity. We as investors expect you to be profitable at some point. So that was much of the basis for my SoFi investment. Basis one was that I'm a client, and I've had a very good experience using the service. Two was that, when I looked into the company, they hit my three marks for a strong growth company, which is, once again, member growth, revenue, and net income. So those are the three things that I like to see when investing, just three of them. There's more, and I'll do a follow-up video to this one. But generally speaking, those are three very strong indicators of a potentially good company. So once again, SoFi is going to be going public on June the 1st. They'll be trading under ticker symbol SOFI. Keep an eye on it. Leave a note in the comments if you agree or if you disagree. Also, don't forget the like button to support the channel. Thanks, guys.